Good evening, students. Assalamu alaikum to all of you, and welcome to day 2 of the practice to pass session of ACCA. So, in day 1, we have discussed about some of the adjustments of the balance sheet, and we have not yet covered the balance sheet area. So, today we are going to cover the balance sheet as well as the main topic for today's coverage is the statement of profit and loss with some interpretation. Just a quick review of what we had already discussed in the last class. It's about the basic definitions of the consolidation, the definition of control. Then we have done some questions, the concept of associate. So these all were already discussed in day 1. So if you have missed the first day session, you can check the video on the Vimeo available. Then the control chart, some questions. So these are the area. Then we have discussed about some adjustments through this chart structure, the concept of net assets, question practice for the net assets, goodwill NCI at acquisition for proportionate and fair value. Then the concept of impairment, the cost of investment. Then consolidation, property, plant and equipment, adjustment of the fair value. And then the concept of NCI. So these all are the areas that we had discussed in the last class. Non-controlling interest, consolidated retained earnings, and one question for the retained earning. So green companies. So did we attempted this question the last session? The yesterday video is already available on the Vimeo, and if you didn't find the video on the Vimeo, then you can send me the message. Yeah, the management is sharing with you the contact of ACCA Pakistan on Vimeo. You can check on the channel of ACCA Pakistan day 1 video of financial reporting. So if you didn't find the video, you can just send me the message on the WhatsApp. I will add you in the group and will share with you the link of the day 1 webinar. So let's start with this question. To have a quick overview about what we had discussed, the requirements is what amount should be shown for the consolidated retained earnings, the statement of financial position. My number that's my number. I'm sharing with you guys. So please do attempt this question. I'm giving you just 1 minute for this. So your requirement is to calculate the retained earnings of the green company. So first you need to take the retained earnings of the parent company. The parent company's retained earning is 116. For the subsidiary company, you need to take the post-acquisition profit. So the retained earnings at end is now, right now it's, or you can say the net asset at end is 50. And the net asset at the acquisition was 40. So there is a post-acquisition profit of 10. 10 into 70%, the value will be 7 for this. $25 is the value of the goodwill, and 20% of this goodwill is written off. So there is an impairment loss of 25 into 20%. Should be 5 into 70%. The amount will be 3.5. So this will be the final answer for this question. My voice is clear. Can you hear me? Yes. 136 is the value of net assets that includes share capital and retained earnings. How did we calculate the impairment loss? Impairment loss, actually the goodwill mentioned in this question is 25. So 25 is the amount of the goodwill and 20% of the goodwill was written off. That means the goodwill for the current year is 5. So the answer will be 119.5. So what we have done, we have taken the figures of the retained earnings of the subsidiary company, that's the total amount. Retained earnings at start, which is 116. So you can take the difference between the retained earnings at reporting date and the retained earnings at acquisition as the post acquisition retained earnings. But in the question, it says that the date of acquisition, the fair value of net asset was 40. So if the fair value of net asset is 40, then you can compare this figure with this value, which is 50. That means that the value of the net assets of the blue company at the reporting date is 50, and at the date of acquisition, it was 40. So the net asset has grown from 40 to 50. So there is a increase in the profit of 10. That is called post acquisition profit. So post acquisition into 70% will be allocated in the retained earnings and the remaining 30% will be distributed to the NCI. I hope it's clear now. The next question for you guys, just for a quick revision. The question is asking for the total equity. So when the examiner is asking about the total equity, that means the share capital plus reserves. So we have acquired and we need to calculate the total equity attributable to the owners of the parent. So we have acquired 75,000 shares out of 1 lakh. So our holding percentage is actually 75%. So first you need to start with the share capital. Remember this point that only the parent company's share capital should be reported on the consolidated balance sheet. Only the parent company's share capital. For the subsidiary company, we take the retained earnings of the parent in full, and for the subsidiary, we will take the post-acquisition retained earnings, which was previously at the acquisition having a value of 90. So the retained earnings has grown from 90 to 150. So there is a post-acquisition profit of 60. And out of this 60, our share of profit is 75%. And that's it. So the final answer should be B, 470. Wonderful. Yes. There are 2 years after the acquisition. Now, the final question for you guys, in which you are required to calculate retained earnings. What is the total charge to the group retained earnings as a result of the consolidated adjustments? So, what amount should be reported in the retained earnings? So, these all questions are from the past papers and from the examiner's reports that will be considered as one of the toughest questions with respect to the examination. So if you are easily solving these questions, that means that your concepts are improving day by day. I have shared an special plan for the resitters. I request all those students who got flunked previously to follow my plan strictly. Inshallah, you will see the results improving in June attempt. The first timers can also follow this plan, but for the resitters, they have to follow that plan very strictly. And those who haven't joined the group on the WhatsApp, I request those students to please join the group so that we will discuss the matters on the group and the concepts, and definitely will share some useful techniques and tips on the WhatsApp group. So is it done? Okay, let's start solving this question. On 1st January, Pratt company acquired 80% of the equity shares of Sam company. Remember this point that whenever you are going to solve the MCQs, we only have 2 to 3 minutes to solve a single MCQ. Pratt company's non-controlling interest at the fair value and at the date of acquisition, the goodwill was valued at 20,000. So we have been given a value of the goodwill, which is 20,000. At 31st December 2005, the goodwill was fully impaired, and in conducting the fair value exercise of Sam's net asset at acquisition, Pratt concludes that the property plant and equipment with a useful life of 5 years had a fair value 5,000 in excess of its carrying amount. Adjustment into the consolidated financial statements. So what is the total charge to the group retained earnings? So in the retained earnings, we haven't been we didn't examiner didn't give us the retained earnings of the parent company and the post-acquisition profits of the subsidiary company. So we only have impairment loss, which is the total amount of the goodwill, and our share will be 20%. So it will be 16,000. And there will be an excess depreciation by dividing 5,000 by 5. You got the value of 1,000 for the year. So there will be an adjustment of 1,000 into 80%. That will be 800. The right answer will be A, 16,800. Wonderful. ED means excess depreciation. Is the additional depreciation that you need to charge whenever there is an upward revaluation. Yeah, it is actually an expense, so it should be debit in the retained earnings. Okay, let's solve this question. What will change in the calculation treatment? Previous question, if the asset was of the subsidiary and acquired MTA. So if the acquisition was the mid-year, so you need to proportionate the profit between the two periods, and then you will be able to find out the net assets at the date of acquisition. So here we have a question for you guys. I want all of you to solve this question. I'm just solving it quickly for you, but my recommendation for you guys is to solve this question directly on the ACCA practice platform. So right now I'm solving it on Excel sheet for your convenience, for my convenience in fact. So let's solve the question on the sheet. So whenever you are going to start the question, always make a line, a column, to differentiate between the workings and the final presentation. So let's solve this question. It says on 1st April 2006, Pepper purchased 90% of the Sauce shares. Okay, the group share is 90%, the NCI share is 10%. Okay. The second thing that you need to calculate is the net assets. Net assets at acquisition, net assets at reporting. You should learn the art of solving this question, consolidation, in 30 minutes, not more than that. The first thing is the share capital of subsidiary company, which is 10. So 10, it should be mentioned 10,000 for both the sides. Then the retained earnings at the reporting date. Retained earnings is 4,200 at the reporting date. And at the date of acquisition, the retained earnings was 3 million. 3,000. Do we have any fair valuation adjustment? We don't have any fair valuation adjustment in this question. So the final answer for this question will be 13,000 for at the date of acquisition and 14,200 at the reporting date. So my post acquisition profit will be the difference between this amount minus this amount. That is 1,200. Then we need to calculate the goodwill figure, which starts from the cost of investment. And the question is saying that we have acquired the shares for 19,000. That is the cost of investment. Then we need to take the NCI at acquisition. NCI at acquisition was valued at 2,000. Less fair value of net assets. It's already mentioned here. That will be my goodwill at acquisition. So I'm just trying to solve this question in front of you to give you an example that how in the examination you guys should have to respond to the question. Otherwise, you'll be losing your marks and you will not be able to complete the papers in the given time. The impairment is 200. The goodwill at reporting will be the difference between these two figures, 7,800. Yes, you can use shortcuts for the workings. COI means cost of investments. But whenever you are going to prepare the balance sheet, you need to show the full amount. So the goodwill is presented here. So after the calculation of the goodwill, you can go and prepare your balance sheet. So it should start from the consolidated. Statement of financial position as at whatever be the date. Then you need to show the name, Pepper Group, then currency unit and the precision level is important with respect to examination. So first, there should be an adding of assets, non-current assets, and it should include the property, plant, and equipment. The property, plant, and equipment is of the parent company is 23,000. The subsidiary company should be 13,000. There is no other adjustments. So final answer will be goodwill. Goodwill is already calculated here, so need to show the reference that we have calculated the goodwill of 7,800. Then current assets, 8,500 plus 3,200. 8,500 plus 3,200. No other adjustments. Now this is how we can calculate the total assets. That is my total. Then equity of the company. Share capital will always be reported for the parent company, which is 30,000. Retained earnings. So all you need to do to calculate the retained earnings and NCI. And then we don't have any non-current liability. The current liability is 7,400. $7,400 plus 2,000. Amount will be 9,000. So if you calculate the retained earnings figure and the NCI figure, you will be able to solve this question. And this question like the last one. Numbers in full. Yeah, if you're reporting the full amount, then you need to just report. You need to show the dollar sign only. Should we also spread user column like this in the exam? Yeah, you need. That's why I'm showing it in front of you guys, that you need to make a wall for the column so that you can separate your workings and your final presentation. And this question like the last one, why the goodwill was not apportioned? We never apportion the goodwill in the fair value approach, or even in the proportionate approach. We never apportion goodwill. It was in the previous question, it was mentioned that there was an impairment in the goodwill. So impairment will only be adjusted when it was mentioned in the question. So they show the amount of, I think, 200 rupees as an impairment. So therefore we charge 200 as an impairment loss. Now what about the retained earnings? Let's solve the retained earnings. As far as the workings concerned, you can take the shortcuts. Retained earnings of the parent company should be reported first, which is 13,100. Then we need to take the NCI acquisition. It is 2000. Then subsidies post acquisition profit is 1200. Is already calculated here. The 90% share will be distributed to group, and the 20% share of this amount, 10%, will be distributed between NCI. Impairment loss should be a portion between the group and NCI. 200 into 90% presented here, and 200 into 10% should be shown here. So this is how we have calculated the figures of retained earnings in NCI. So we should give the link of the retaining from here, and you should give the link of NCI from here, 2100. So by adding this figure, your equity and liability will be equivalent to your assets. That's my assets. So that's it. So there are some key points that you need to learn from this practice. The first thing is fair valuation adjustment and the revaluation. Fair valuation adjustment can be carried out in any assets. But when we talk about the revaluation, it will only be done in the non-current assets. Okay. Examiner might ask you, when the examiner is going to check the question, he will check the question from by clicking on this link, which shows the working of 23,000 plus 13,000. This is how you have calculated the amount of 36,000. Now remember this point, that if you just write the 36,000 amount without any proper working, you will get no marks. So both are same, but here you can get 1, 2 or 2 marks, and here you will get the 0 marks, because when the examiner is going to click on this amount, there will be no breakup how that you have calculated 36,000. So if you will not show the workings in the examination, you will get 0 marks. Either your answer is right or wrong. Similarly, when the examiner wanted to check about the goodwill, it says to go and check on the G25. So examiner will go and check on the G25, which says that you have calculated the goodwill. Through this working, he will check this working of you and then says, okay, it's fine. So for every amount that you are showing on the face of the balance sheet or income statement, should be shown with the reference of the working, either directly in the cell, or you can show the cell reference like we have done in the NCI case. But if you directly go and punch your answer in numbers without any reference, you will get 0 marks. Like you have calculated NCI and K19, which is 2100. Even if you have calculated but you didn't give the link and just show 2100 directly in the examination, you will get 0 marks for NCI because of the fact that you didn't show the working. So you cannot expect examiner to go on the right hand side and check the working of NCI. So you need to show the link for your working. So I think it's fine. If you wanted to ask anything. No, directly. You have to show each and every when it talks about section C. Always remember is that you can never punch the amount directly by doing the calculation, the calculator, and punch the amount. You will not get the marks. Remember this point. So you need to for section C you need to show the workings. So this is the format for the retaining earnings here. Is it clear? Wonderful. So let's start with some of the adjustment of the balance sheet. The first one is about the loans and investments. Remember this point that when we are talking about the consolidation, we always cancel out all types of loans between the parent and subsidiary. So any type of the loan that exists between the parent and subsidiary should be cancelled. Similarly, all types of receivable and payables should be cancelled out with each other, and all types of unrealized profit should be adjusted. Unrealized profit can be for inventory or it could be for the non-current assets. Like we have sold the non-current assets. So it's also possible for you guys to adjust the depreciation along with the analyzed profit. Then we have cash in transit or goods in transit. In transit means the amount of the cash has not yet been received by the company or the amount of the goods has not yet been received by the company. This is called cash or goods in transit. So now I'm showing you 6 cases where you need to show the accounting entry. Like for example, if the parent sold goods to the subsidiary company, accounting entry will be retained earnings debit and stock credit. So I want you all of you guys to make the accounting entries, relevant accounting entries and relevant formulas. So please write the accounting entries here. Okay, so talking about the situation, can you hear my voice? Actually, I've given you the time to solve these accounting entries. So let's start making accounting entries. From parent company to subsidiary company. If the parent company sold goods to the subsidiary company, accounting entry will be retained earnings debit and stock credit. From the subsidiary company to the parent company, the accounting entry will be retained earnings and NCI debit with their respective percentages, and stock will be credit. Now, what about the next adjustment? Whenever the parent sold goods to associate company, what will be the accounting treatment? The accounting entry should be retained earnings debit and investment in associate credit. Remember this one. If the subsidiary company is selling goods to the associate company, the accounting entry will be retained earnings debit and NCI debit and investment in associate credit. So you should know the impact of the transaction with the associate and unrealized profit. When the associate company sold goods to the parent company, the accounting entry will be retained earnings debit and stock credit. And when the associate is selling to the subsidiary company, the accounting entry will be retained earnings debit and stock credit. So these are the treatments that you should know for the unrealized profit. So remember this point that you cannot recognize the profit from the members of the group. So that's why we called this profit as unrealized profit. So unrealized profit between the parent and subsidiary will be calculated as the profit in the original transaction multiplied by percentage of stock still in warehouse. And for the associate, the formula is same, plus there is an additional thing, that is you need to take the associate percentage as well. Retained earnings and NCI. It's retained earnings and NCI. These two accounts should be debited with their respective percentage. Associate is considered outside the group. Why we are adjusting the unrealized profits? We are adjusting only for our share of interest in the associate. We are not making the accounting entry for the whole amount. We are just taking, because we are taking the our share of profit in our books. So you need to adjust only that portion of the amount that we have recognized in the books. When the associate, actually associates profit will also go in the retained earnings. That's why we need to debit the retained earnings figure. If we talk about the group, what would be the entry of associate? I didn't forget your point. My laptop battery is a little bit low. You don't need to worry about it. I have a charge with me. I'm just attaching in a minute. Connected now. If the associate sells to the parent, this is the case that you are asking. If the associate company is selling goods to the parent, the accounting entry will be retained earnings debit and stock credit. So these are the accounting entries that you need to learn. Investment will only be credited when associate is a buyer, not the seller. Yes, stock means inventory. Next thing is how we can calculate the consolidated inventory. Consolidated inventory can be calculated by adding the parent's inventory plus subsidiary inventory plus fair valuation adjustment if there is any fair valuation adjustment at the date of acquisition. And you need to deduct the unrealized profit and you need to add the goods in transit. Goods in transit means the goods that has been transferred by the subsidiary to the parent or the parent to the subsidiary, but it has not yet been received by the company who has uh, purchased it. Like if the subsidiary company is selling goods to the parent, but the parent company has not yet received the goods. So the goods are in transit. So what we need to do, we always record this by debiting the inventory and crediting the account payable. So for the purpose of consolidation, the goods in transit will be considered as that we have received. Okay. Yes, this is the intergroup transaction. That's an unrealized profit is actually an intergroup transaction that you have earned the profit from the other members of the group. Is it done? So remember this point that the goods in transit means the goods that you have not yet received from the parent of the subsidiary, and we assume that the goods that you have not yet received has been received. What type of fair valuation adjustment may come here? Fair valuation adjustment means, as we had discussed in the last class, that at the date of acquisition, all the assets and liabilities of subsidiary should be measured at the fair value. So there might be a fair valuation adjustment in the inventory at the date of acquisition. So you need to do the adjustments for the fair valuation adjustment, but you need to see whether there is if there is an upward fair valuation adjustment in the inventory, then you need to see that whether that inventory existed at the reporting date or not. Wait, I'm going for the cash in transit. It will be discussed in the next class, next slide, in fact. So you guys are required to solve this question based on the information that we have gained from the slides. So you have 1 minute to solve this question. So Both the inventory should be added. Parent plus subsidiary. The group's inventory should be 15,000 plus 17,000. There is no fair valuation adjustment in this question. There is no goods in transit. So all you need to do is to deduct the unrealized profit. So we are calculating the unrealized profit here. The inventory includes 8,000. 8,000 is the price of the goods at a cost plus 25%. Means the profit will be 25 upon 125. So it should be deducted from here. So annualized profit is 1,600. So when you deduct 1,600, the value will be 30,000. 30,400. That's my answer. What the goods are made, but these goods are still held in the inventory now. If the question says to you that the call inventory includes 8,000 of the goods purchased from the Suzanne, but they have sold that inventory outside the group. So at that time, there will be no need to adjust that inventory. So we never do proportionate consolidation based on the percentage or based on the time period of that we have acquired in balance sheet. Please solve this question, Petula. It doesn't matter that at what date we have acquired the company, because we always do the proportionate consolidation for income statement items, not for the balance sheet. Please solve this one. Okay, so let's start solving this question. Petula acquired 80% of Sanka on 1st October 2005. At this date, some of Sanka's inventory had a carrying amount of 600,000, but had a fair value of 800,000. So now you can see here that at the date of acquisition, there is an upward revaluation or fair valuation adjustment of an inventory, which is 2 lakh. But by 31st December 2005, 70% of this stock had been sold. So this stock, which was held by the subsidiary company at the date of acquisition, was sold. So only the 30% was retained in the warehouse. So you can only adjust 30% of the stock. So at the date of acquisition, okay, at the reporting date, the inventory of the parent company is 3250. Inventory of the subsidiary company is 1940. Plus there is a fair valuation adjustment of 60. And that's it. So the right answer should be A. Wonderful. Yes, inventory should be measured at the lower of cost and NRV. That's true. But it is the measurement of IS2, which will be applied on single company. But when we talk about the consolidation, we need to follow the rules of the consolidation, which says that all the assets and liabilities of the subsidiary can be revalued either upward or downward at the date of acquisition if the fair value is different from the carrying amount. Yes, if it is a downward fair valuation adjustment, then you need to deduct that amount. And why we are taking 30% of the amount? Because of the fact that only 30% of the stock is still held when we are preparing the balance sheet at the reporting date. Yes, we need to do the fair valuation adjustment at the date of acquisition, which was 1st October. Like on 1st October, there will be a fair valuation adjustment of 2 lakh. But when we talk about the reporting date, that is 31st December, it says that the subsidiary company has sold 70% of the stock to outside the group. So only 30% is still held in the inventory. So only the 30% of this fair valuation adjustment can be reported at the reporting date because we only have got 30% of the stock. So that's why I have just added 60 amount. But if the question is asking about the inventory at the date of acquisition, then we should add 200 in the total inventory. 19540 is the closing stock of subsidiary company. This is just not against the concept of IS2. No, consolidation has got some different rules that you need to follow. Yes, if the inventory was sold by the subsidiary company, then you need to add 200,000 directly. Why we take is it clear to all of you? Now, talking about the property, plant and equipment. Consolidated property, plant and equipment will be reported as the property, plant and equipment of the parent plus the property, plant and equipment of subsidiary plus the revaluation gain. Sometimes there might be an upward revaluation gain. In this case, there will be an excess depreciation. And sometimes there will be a downward revaluation or unrealized profit of non-current asset. In that case, you need to make a reversal of depreciation. So when there is an upward revaluation, there will be an excess depreciation. And when there is a downward revaluation, there will be a reversal of depreciation. This is called consolidated property, plant and equipment. Please copy it. It will be useful from the exams point of view. And if you memorize these formulas, you will get 100% answers with respect to the examination. So please do attempt this question. West has 75% of subsidiary life and is preparing its consolidated financial statement position as at 31st December 2006. The carrying amount of the property and equipment of West in so the property, plant and equipment of parent company is 300,000. The subsidiary is 60,000. Then you need to see whether there is an upward or downward revaluation or there is a unrealized profit. So you can see here the West company transferred some of the property for 40,000, which had a cost of 42,000, which is irrelevant, having a carrying amount of 30,000. So parent company has got a non-current asset having a carrying amount of 30,000 was transferred or sold to the subsidiary company, the value of 40,000. So there will be an unrealized profit of 10,000. Plus you need to make the reversal of depreciation adjustment for this case. So 10,000 is the amount of the profit that has been booked, and the depreciation will be overcharged on this 10,000. So you need to make the adjustments and reversing the depreciation amount. So 2,000 into January December, so 2,000 will be added back. So the right answer should be 3,52,000. Very good. Is it clear? Why did we reverse the depreciation? Because you can see here it says that the parent company is having a non-current asset value 30,000, which was sold to the subsidiary company at a value of 40,000. So from this date, 1st January, the subsidiary company has recorded its asset at a value of 40,000. I'm charging depreciation on this asset based on 40,000. But for the purpose of consolidation, we must say that you cannot recognize the profit of 10,000 from the internally generated from within the group. So that's why there is a profit element of 10,000 in this asset. So you need to adjust the depreciation, related depreciation of this 10,000 only. So we have overcharged the depreciation. That's why we are making the reversal entry of the depreciation. Why didn't we use 42,000? 42,000 is the historic cost of the asset. So whenever there is a transfer or disposal of non-current asset, we always have to take the current fair value and the carrying amount rather than the historic cost. No, it's not 1,000, it's 10,000 actually. So 10,000 is the difference between the fair value and the carrying amount. So one of the students wanted to know the double entry, accounting entry for this transaction. Actually, parent company has sold the asset to the subsidiary company. So who has earned the profit? It was actually the parent company who has earned the profit of 10,000. The accounting entry should be retained earnings debit by 10,000 and the property, plant and equipment will be credited by 10,000. If the transaction was the other way around, then we never used the 42,000 because it was the historical cost of the asset. So the treatment will be similar, but when the subsidiary company has earned the profit, you need to distribute the profit between the group and NCI. So the final answer for this question is 352,000. Do you have any doubts? If you have any doubts, you can ask. Sold by the subsidiary to the parent. And if the subsidiary company has sold the asset to the parent, the treatment will be retained earnings debit, NCI debit, and the property, plant and equipment credit. If the subsidiary company is sold. So right now we are not talking about the retained earnings and NCI. Actually, it was the case of property, plant and equipment. So our main focus is on property, plant and equipment. So remember this formula: parent's property, plant and equipment plus subsidiary plus revaluation gain minus excess depreciation minus revaluation on unrealized profit plus reversal of depreciation. And now solve this question. Okay, is it done? The parent share is 138. The subsidiary is 115,000 minus unrealized profit of 5,000 plus excess depreciation of reversal of depreciation of 1,000 from June, July, August, September, October, November for the 6 months. So it will be 500. So the final answer should be 285, 248, 500. Prepare the extract means that you need to show the workings and calculate the amount that will be reported on the consolidated balance sheet. This 5 is the useful life of the asset. Yes, 5,000 divided by 5, we got the value of 1,000. But we can see here that this transaction took place on 1st June. So from the 1st June till the 30th November 2007, you need to make the adjustment for the 6 months depreciation. So that's why I took 6 by 12 or 1,000. So depreciation is calculated at 5,000 analyzed profit divided by 5, which will be 1,000, and 6 by 12. 1,000 is so date is very crucial and important whenever you are doing questions. Now, talking about the concept current account. With respect to the current account, we never recognize parent or subsidiaries, debtors or creditors in the books. So if the value of the debtor is 100 and the value of the payable is 100, you simply need to cancel out these transactions. Similarly, there might be some investment and the loan transaction, parent company has provided loan to the subsidiary company, it will also be cancelled out. There will be interest receivable and interest payable, 10 and 10, so it will also be cancelled out with each other. There might be dividend receivable case or dividend payable, so the common amount will be cancelled out with each other. We never recognize any transaction which is the intercompany in the consolidated financial statement. Will the 5,000 unrealized gain be proportion between the parent and subsidiary? In the previous question, 5,000 unrealized gain. Who sold the? Actually, you're talking about the retained earnings and NCI. Carl has sold, transferred an item. Carl transfer means the Carl has made the profits. So in the parent's profit, there will be no share of NCI. So the whole amount will go in the retained earnings. So the accounting entry will be retained earnings debit 5,000 and the property, plant and equipment credit by 5,000. Okay, is it clear? Now, there is a concept of cash in transit. Now, please try to understand this concept. Cash in transit concept occurs when the parent company, assuming it has got the receivable of 100, and the subsidiary company has got the payable of 100. So if this is the case, though, then you simply need to cancel out these two transactions. But the cash in transit arises when it says that the subsidiary company has paid 30 to the parent company and its value is now 70, which is not going to reconcile with the related receivables of the parent company. So as the subsidiary company has paid the amount of 30, but the parent company has not yet received the amount of 30. The accounting entry should be cash debit and receivables credit by 30. So we assume that the cash that was in transit has been received by the parent company. So when you receive the amount, the treatment will be cash debit and receivables credit by 30, and the value of this transaction has become 70. So now you are in a position to cancel out these transactions 70 and 70. So what you need to do is to first recognize the transaction of cash in transit in the books of receivables, and then this amount will be equal to the current account. If it is clear now, then please do attempt this question. Okay, now let's solve this question. The investment is having a value of 8,000. Then we have got the receivables and payables. It says that P paid 3,500 for its investment in share capital of S. So there is an investment of 8,000 by the parent company, out of which 3,500 was made in subsidiary company, which will be used for the calculation of the goodwill. So remaining amount will be 4,500. At the same time, P invested 60% of 8% loan stock. So loan stock of the subsidiary company is 500. So parent company has given 60% of this loan. So 60% of this loan will become 300. So 300 is investment in loan. And the remaining amount will be the other investment of parent company. So what you need to do is to cancel out 300 from this investment and 300 from this non-current liability, because we never recognize intercompany transactions. Then it says at the reporting date, parents payable included an amount due of 400. Parent company's liability includes an amount of 400. This did not agree with the corresponding receivable. This 400 is not reconciled with the receivable figure of the subsidiary company, because subsidiary company's financial statements shows an amount of 500 in the books receivable from the parent. So there is a difference of 100 which will be considered as a cash in transit. So actually it says that previously it was parent and subsidiary. There was a receivable of 500 in the books of parent. So the same amount should also be reported in the books of subsidiary parent company. These two amounts should be equal. But it says that subsidiary parent company has paid 100 and its liability has now become 400, which is not reconciled with the related receivables in the subsidiary books. So the difference is cash in transit. Now what you need to do is to record this transaction in the books of subsidiary company as that we have received. So the cash will be debited by 100 and receivable will be credited by 100. So when you record this transaction 100 in the books, it will be equivalent to the related receivables. So it should be cancelled out with each other. Okay. And that's it. So now when we are preparing the consolidated financial statements, investment will now be reported at 8,000 minus 3,500 for investment in subsidiary and 1,500, 300 for the loan stock. So it will become 4,200. For the receivable side, there will be 1,400 plus 650 minus 100 plus minus 400 for the receivables. For the bank, we need to add 600 plus 150 plus cash in transit of 100. For the loan stock, the amount will be 4,000 plus 500 minus intercompany transaction of 300. For the payables, the amount should be 2,800 plus 1,300 minus payable of 400. So this amount and this amount should be the intercompany investment and loan. Then we have this 400 and this 400 are equal. So is it clear now? If yes, then let's take a break. Yeah, 10 will be added in the bank. So this question will be your home assignment. This will be your home assignment. For your guidance, I'm telling you that answer is D for this question. You need to solve it by yourself at home. So let's take a break of 10 minutes, then we will start after the break. Yes, we have deducted 3,500 because this 3,500 will be used for the calculation of the goodwill. You can see in my previous slide that I have deducted 3,500. I'll show you here. Check this one. So let's take a break of 10 minutes. Okay, welcome back after the break. Uh, so before the break, we were discussing about the concept of current account, cash in transit, goods in transit. So now let's start the new concept, that is the concept of associate. An associate is an entity over which the investor has the significant influence. Significant influence means power to participate in the decision-making process. An associate is presumed when you have got 20% or more ordinary shares. Remember this point that the associate is not consolidated, so none of the associates' income and expense and asset liability will be included within the group accounts. There is no non-controlling interest in associate as it is not a consolidated. It should be accounted for under equity method with this formula. So this is the only single line adjustment for the associate company. The first thing is the investment should be recognized at cost. Yes, ordinary shares means equity shares, and preference shares are also called equity shares if they are irredeemable in nature. Okay, the investment will initially be recorded at cost, then it will be adjusted for the post acquisition profit into associate percentage minus impairment loss. Remember this point, we never apply percentage on the impairment loss, minus dividend received, and minus unrealized profit. Unrealized profit will only be accounted for here when the parent or the subsidiary sold goods to the associate company. Mean the associate is the buyer or the purchaser. Then we will adjust the unrealized profit from the investment in associate. I hope it's clear now. Yes, we have to consider only a dividend received that we have received from the associate. Yes. Now here's a question for you guys. I want you guys to attempt this question and reply your answer in the chat box. You have 1 minute. Unrealized profit will never be time apportioned. Remember this point, because the sale was carried out in the post-acquisition period. Johnson paid 1.2 million for 30% investment in Threem equity shares on 1st August. Threem profit after tax for the year ended was 7,50,000. On 31st March 2005, Threem had 300,000 of the goods in inventory, which it had bought from the Johnson in March 2015. These had been sold by the Johnson at a markup of 20%. Threem had not paid any dividends. On the assumption that the Threem is an associate of the Johnson, what would be the carrying amount of the investment in the Threem? So you need to calculate the investment in Threem, that is associate, investment in associate. So it initially we recognize at cost of 1,200. Subsequently, you need to take the post-acquisition profit. So we have acquired the associate on 1st August and the year end is 31st March. So from August to March, August, September, October, November, December, January, February, March, it will be 8 months. So in the post-acquisition period, we have earned a profit of 7,50,000 into 8 upon 12, and out of which our share of the profit is 30%. Minus there is no impairment loss. Now, Treem had 300,000 of the goods in inventory which had been bought from the Johnson. Johnson means Johnson sold goods to the Treem means the parent sold goods to the associate company. So whenever the parent sold goods to the associate company, you need to adjust the unrealized profit from the investment in associate. So 300,000 is the value of the goods that was sold by the parent to the associate company. These were sold at a markup of 20%, 20 upon 120. Stream has not paid any dividends. So the unrealized profit will be 60,000. 3 lakh into 20 upon 120 is, I think it's 60,000. Three lakh into 20 upon 120, it's 50,000 actually. Okay, the amount is 50,000, and our share of the interest is 30% in this situation. So it will be 15,000. So you need to adjust 15,000 from here. So the answer should be the answer for this should be A. That will be 133,500. Wonderful. If the associate sold goods to the parent, then you don't need to adjust the investment in associate. Okay. So here is another question for you guys from the past paper. Calculate the carrying amount, the investment in the branch company. So please solve it. What are the disclosure in SFP and SOPL? In the SFP, you need to disclose the amount of 133,5 it will be reported in the statement of financial position. And with respect to the income statement, you need to adjust the share of the profit minus impairment loss. Impairment, we never apply the percentage on the impairment. Only the percentage will be applied on the dividend if the full year dividend of the company was given to you. Okay, technically speaking, there is a question and confusion that what if A sells goods to P, and what's the difference between P sells goods to A? So you need to understand this, that whenever the A sold goods to the P, then inventory will be held by parent company, and the profit will be earned by the associate company. The accounting entry will be retained earnings debit and stock credit, because the parent's inventory has nothing to do with the investment in associate. But when the parent sold goods to A, that means that stock will be held by the associate company and the profit will be earned by the parent company. So the accounting treatment will be retained earnings debit, as we never consolidate associate stock. Therefore, we need to adjust this from the investment in associate. So that's the logic behind these two transactions. So you can never adjust the investment in associate when the A sells goods to the P. So it might be a printing error in the book, but the real concept is here. Okay, let's solve this question. Parent Root acquired 30% shares of the 100,000 equity shares branch for 7.5 per share. So out of 1 lakh shares, we have acquired 30%. So it will be 30,000 shares, and we have paid 7.5 per share. So 30,000 into 7.5. So it will be 2,25,000. And the branch had a retained earnings of 46,000, 4,60,000, and the balance on the revaluation surplus was 50,000. At the year end, at 31st December 2007, branch had a retained earnings of 3,70,000. So from the date of acquisition till the till the year end, the retained earnings has grown from has gone down actually from 4,60,000 to 3,70,000. So there is a post acquisition loss in associate company that will be 90,000. So 90,000 into 30%. So 27,000 is the amount of the loss for the associate. And its revaluation surplus has grown from 50,000 to 70,000. There is a gain of 20,000 in associate into 30%. That will be 6,000. Company considered its investment in branch company had suffered impairment loss of 40,000. So we never apply a percentage on the impairment. So the amount will be 225,000 minus 27,000 plus 6,000 minus 40,000. 1,64,000. Is it clear? Wonderful. If you guys have any question, please do ask it immediately. It's wonderful. Now, moving towards the next question, next points, key points. All assets and liabilities of subsidiaries should be measured at the fair value at the date of acquisition. So this is the point of IFRS 3 on the basis of which, why do we add revaluation surplus? Actually, when we have acquired 30% shares in the associate company, we have 30% stake in all the profits of the associate company. So we have got 30% stake in all the profits of the associate company. But with respect to SOPL, in SOPL, there will be a loss of 27,000. That will be go, and an impairment loss of 40,000. So the total of 67,000 will go in the SOPL, because revaluation surplus will go in the OCI. Yes, revaluation surplus is undistributable, but all the profits, because it will be realized later or sooner when the subsidiary company will sold the asset. So once you have got the shares, remember this point, that when you have got the shares or stake in a particular company, you have got the right of all the reserves of the company. It could be a retained earnings, it might be any other reserve. So all the assets and liabilities of subsidiary should be measured at the fair value at the acquisition date. That's a very important point. So this is the reason for the fair valuation adjustments, which could occur in tangible assets like property, plant and equipment, intangible assets like software and inventory, or any other liability. All intangible assets should be recognized for the purpose of consolidation. Very important point, because IAS 38 says that you cannot recognize the internally generated intangible assets. But for the purpose of consolidation, we recognize all types of intangible assets for the purpose of consolidation. Contingent liabilities according to IAS 37 should be disclosed in notes. We never make the provision for the contingent liabilities, but for the purpose of consolidation, it is always assumed that the fair value is reliably measurable. So we should recognize a provision against all the contingent liabilities. Consolidation should be on the basis of control and not on the basis of ownership. We never apply percentage based on the ownership. Like if you have got 60% shares, so we never apply percentage on assets or liabilities or revenue or income or expenses. Nothing should be based on the ownership. Everything should be based on the control. Once you have got the control, everything is yours. Only you need to take the percentage when you are distributing the profits. Similar items like asset plus asset should be merged, liability plus liability should be merged, and all intercompany balances should be cancelled. So these are the 4 to 5 fundamental points of yes, all internally generated intangible assets should be included for the purpose of consolidation. So these are very important and fundamental points for the consolidation. Next point. So this is the basic structure. These are the steps that you need to follow when you are working for the consolidation. Identify the date of acquisition, a very important point, reporting date, group structure, area of consolidation like balance sheet or P&L, adjustments, prepare net assets of subsidiary at acquisition, goodwill, NCI, consolidated reserves, balance sheet, and P&L. So these are the intercompany means yes, between the parent and subsidiary. Please explain the contingent liability point. I'm saying that according to IS 37, all contingent liabilities should be disclosed by notes. We never recognize provision for the contingent liabilities, but for the purpose of consolidation, we always recognize the provision for all the contingent liabilities. Now here is a question for you guys that you need to attempt. That's your home assignment. Now, net assets and liabilities means all assets and liabilities should be consolidated 100%. No proportionate consolidation is allowed in balance sheet or P&L. Share capital and share premium will only be reported for the parent company. Yes, in the retained earnings, you need to take 100% of the parent share, but for the subsidiary, you need to take the share of the post-acquisition profit, because part of the profit will be distributed to NCI. Like 80% is, if we are giving 80% to group, then 20% will be distributed to NCI. Okay, it was actually the profit which will be distributed. Now, attempt past paper balance sheet related questions. Now, you are in a position to attempt questions of the balance sheet from the past papers. So attempt question from past papers of 2018, 2019, and 2020. So these are the 3 years for which you will be having some questions of the balance sheet. Okay. So now you are in a position to attempt, but remember this point that whenever you are going to solve these questions, long questions, always attempt this question on the constructive response workspace. So if you have no idea about the constructive response workspace, you can ask with me or on the group. I will share the link of the constructive response workspace. How do we get the full paper? You will never get the full exam paper because ACCA never publish section A and B. It only publishes section C. Okay, please give the answers to the MCQs and long questions in the handout. I will share the answers of the MCQs and the long questions tonight on the group. Now, let's start the topic consolidated profit and loss. Consolidated profit and loss is very much similar to the balance sheet. If you're not yet added in the group, please send me the message. I will add you. It includes inter-group transactions. The treatment will be similar, that you need to deduct all types of intercompany revenue or expenses. Intercompany, any type of revenue and expenses within the group should be eliminated. We never recognize unrealized profit in the income statement. Fair valuation adjustment, we need to adjust the depreciation figure or the reversal of depreciation. Impairment will be recognized in the income statement, and we need to calculate the share of profit of NCI. So remember this point, that whenever we are going to adjust anything in the consolidated P&L, we never apply the percentage. Like never apply the percentage on the impairment loss, never apply the percentage on the unrealized profit or depreciation. You can time apportion these items, but we never apply the percentage of ownership on any of the items in the income statement. Only you need to distribute the profit between the owners of the parent and the NCI when you have calculated the profit after tax. So the profit will be distributed between the group and NCI only when you calculated the profit after tax. So you can just simply add the impairment loss, which will normally be added in the operating expenses, adjust the depreciation in the cost of goods sold, adjust the unrealized profit in the cost of goods sold, and cancel out all intercompany transactions, and then calculate the profit after tax. Starting from the sales, consolidated sales should be calculated as the sales of the parent plus subsidiary into controlling period minus intercompany sales. Always remember this point, that the income statement will be made for the 12 months actually. If the financial year starts from the January to December, then you need to see that from how long the parent company is being controlling the subsidiary company. Like if the parent company has acquired the subsidiary on 1st January, that means the controlling period is 12 months. So you simply need to add the revenue, assuming its revenue is 1200 and its revenue is 1000. So group's revenue will be 2200. So you simply need to add the revenue of two companies. But if the parent company has acquired the subsidiary on 1st July, so till 31st December, the controlling period is 6 months. So you need to apply 6 upon 12 factor when you are calculating the revenue of the group. So consolidated revenue will be calculated as 1200 plus 1000 into 6 upon 12. So the whole of the income statement item should be proportionated on 6 upon 12 if the date of acquisition was during the year. That is the most important point of income statement consolidation, and intercompany sales should be deducted. CP means controlling period. So you need to multiply this with the controlling period. Yes, you have to always remove the sales value. The second thing is the cost of goods sold consolidated. First, the cost of goods sold of the parent plus subsidiary into controlling period if the time period is less than 12 months minus intercompany sales plus unrealized profit plus excess depreciation minus reversal of depreciation. So these are the points that you need to include in cost of goods sold. So consolidated sales, consolidated cost of goods sold, when we deduct these figures, we got the value of consolidated gross profit. So the most difficult part in the consolidated income statement is to calculate the sales and cost of goods sold. Rest of the items is very simple and easy to understand. Why we are adding up unrealized profit? Actually, we are adjusting the cost of goods sold. So whenever there is a decrease in the stock, there will be an increase, an upward adjustment in the cost of goods sold. ED stands for excess depreciation that you need to charge in case of upward revaluation. RD means reversal of depreciation. That shows that we have overcharged the depreciation, and now you need to reverse the depreciation amount. So here is a question for you guys with respect to the revenue. You are required to calculate the consolidated revenue in this question. So what will be the right answer for this question? The right answer is 5,500 for the parent company plus 2,100 for the subsidiary company, and as they have acquired for the many years, you should simply need to add these two figures minus intercompany sales, which is 1,000. So this is how we have calculated the figure of. So the amount should be 6.6 million. The second question is related to the cost of sales. The cost of goods sold figure will be calculated. First, you need to take Harry acquired an 80% holding in Style on 1st April. So the date of acquisition is 1st April, the year end is 31st December. So from April to December, the time period is actually 9 months. So you need to take 9 months figure for the subsidiary company. So for the parent, Harry is the parent company. 14,700 will be the full amount. But for the subsidiary, you need to take the 9 months revenue. Style subsidiary sold goods to the Harry for 4.3 million at a markup of 10%. And Harry inventory at 31st December included 2.2 million of such inventory. So there is actually 2.2 million of the stock is still held in the inventory, and the unrealized portion will be 10 upon 120. So 2,200 multiplied by 10 divided by 120, 110. So it will be 200. So 200 should be the unrealized profit added here, and as there is no excess depreciation. So the final answer should be 14,000 14,700 plus 11,600 into 9 by 12 plus 200. The amount should be B. I think we have done something wrong. Style sold goods to Harry 4.3 million. The markup Harry inventory included 31st included 2.2 million of inventory. So 2.2 into 10 upon 110. So it will be 200 minus intercompany transaction. Actually, we have skipped the figure of 4,300. So 14,700 plus 11,600 into 9 by 12 minus intercompany transaction of 4,300 plus unrealized profit of 200. So the right answer for this question is D. So there are some students who were asking about the question related to the previous, I think previous one. The last problem too. So do you guys have any issue in this question? Please do ask it immediately. Do you guys have any issue in this question? Percentage. Actually, we are solving this question for the revenue. Whenever we talk about the revenue, there will be no adjustment of the analyzed profit or anything in the revenue. No, actually, revenue inventory has nothing to do with the revenue. Inventory is actually connected with the cost of goods sold. So whenever we talk about the question related to the cost of goods sold, we need to adjust it. Now, any problem in this one? The question related to the cost of goods sold? Why do we add? Answer is A. Someone saying that the answer is A. How A is the right answer? Must Can you give the rationale for A? $14.7 plus 4. No. Unrealized profit should be added, but not deducted from the cost of goods sold. So that's why the answer is D. It wasn't in the formula. Actually, in the formula, it says that you need to take the share of the post acquisition profits. So every profit that has been earned by the associate company, your share is 30%. So revaluation is also a gain or a profit. That's why uh, okay. Why you change the sign of sales and cost of goods sold? Okay, actually it was deducted. That's why I did that. That's okay. Consolidated operating expenses. The mechanism is simple: parent plus subsidiary into controlling period if the time period is less than 12 months minus intercompany expenses plus if there is some impairment loss, then it should also be included in the expenses side. So all of you are required to solve this question. What are the other example of adjustment that can be tested in sales and cost of sold? Whatever format I'm telling you for the sales and cost of goods sold, examiner will not go beyond that format. So it is the total amount of adjustment that could be incorporated in the sales and cost of goods sold. IN means impairment loss. So now let's adjust. Heal acquired 60% of the share capital on 1st January. The year end is 31st December, so you do not need to apply the controlling period. So the parent company's operating expenses is 6 lakh plus subsidiary company operating expenses 3,50,000. Then there is a upward revaluation of 2 lakh and the life is 10 years. So the depreciation that you need to adjust, and it says that all depreciation is charged to cost of goods sold. Usually we charge the depreciation in the cost of goods sold, but this question specifically mentioned that you need to charge a depreciation in operating expense. But if this line was not mentioned, that then you will definitely charge the depreciation in the cost of goods sold. So here, as the examiner is saying that you need to charge the depreciation in the operating expense. So 2 lakh divided by 10 will be 20,000. Goodwill had been impaired by 55,000 in the year 31st December. So there will be a 55,000 impairment loss. So by adding these two all figures, you will get the value of operating expenses, that is 600 plus 350 plus 20 plus 55. So the amount will be 1025 for the operating expenses. Why we should include the 2 years? Remember this point that income statement is for the period of 1 year only. So whatever adjustments you are making in the income statement, it will be for a period of 12 months, not more than that. We are not taking last year's expense. Actually, in 2006, definitely they have charged an expense of 20,000, and in 2007 they need to charge a depreciation expense of 20,000. So we are right now we are adjusting 2007, now not 2006. So we have taken the expenses of 2007 from here, and now goodwill should not be impairment is for the period of 2006. You need to ignore this one. This impairment should be ignored from this question because of the fact that it is for the period of 2006. So only the depreciation should be included here. So the answer should be 9,70,000. That's right. How do we know that we need to reverse the depreciation? We reverse the depreciation in the case when there is a downward revaluation, or when the parent company or subsidiary company sold the assets to the other company. The next question is for the finance cost. I want all of you guys to solve it. A acquired 60% shares in B on 1st July. Yes, normally impairment will be charged in the administration expense. A acquired 60% holding in B on 1st July 2006. At this date, A gave B a 500,000 loan notes, 8%. The interest on the loan has been accounted for correctly in the individual financial statements. The total of the finance cost for the year 2006 in the individual financial statement is 2,70,000. So we are going to consolidate to calculate the finance cost. That should be shown in the consolidated P&L. So 200 is the finance cost of the parent company, less add 70,000 is the finance cost of the subsidiary company. But this finance cost includes an intercompany finance cost, which should be excluded first. So 500,000 is the amount of the loan into 8%. That will be 40,000 interest cost. As we have borrowed the loan on 1st July, so from the July to December, there will be 6 months finance cost, which will be 20,000. So first you need to deduct 20,000 from here, and then we will take 6 upon 12. So 200,000 from here plus 15 to 6 upon 12, 25,000 from here. So the answer will be 2,25,000. Now here is a format for the NCI, that how you can calculate the NCI from the profit after tax. So whenever you have got the profit after tax of the group, we never apply the percentage of for the calculation of NCI on this profit. So you need to take the subsidies profit from scratch, then adjust it for the annualized profit only when the subsidiary company, the seller, depreciation, fair valuation, it will be a depreciation for the fair valuation adjustment, and when there is a reversal of depreciation, it should be added here. Impairment losses only when the fair value method should be deducted. So whatever the amount you will get is the adjusted profit into NCI percentage. That profit will be the profit attributable to NCI. So first you need to take the profit of the subsidiary minus adjustment of three items: analyzed profit, fair valuation, depreciation, or reversal or impairment loss. And after that, you will be in a position to calculate the adjusted profit. Whenever we have got the intercompany transaction, first you need to remove the intercompany, then you can take the proportionate amount. Because in the 70,000 there is a finance cost of 20,000, which is always also, which is actually based for the period of 6 months. So you cannot take 6 upon 12 of 70,000, because that includes 6 months finance cost related to the parent company. So first you need to remove the intercompany finance cost, and then you can take the percentage. Adjusted profit means that the profit of the subsidiary company after all the adjustments of consolidation, that after the adjustment of these three items. So the final answer for this will be reported here, and then we will take the percentage. So I want all of you guys to attempt this question. What is the non-controlling interest in VWX that would be reported in the consolidated profit and loss? So first you need to take the profit of the subsidiary company. Subsidiary's profit. So subsidiary's profit is 6 lakh. Then first you need to adjust the analyzed profit only when the subsidiary sold goods to the parent. So this one is a subsidiary company and this one is a parent company. So VWX reported an you ascertain that at the year end there was an unrealized profit of 60,000 on sales by the VWX to STU. So sales by the subsidiary to the parent. So there will be a unrealized profit of 60,000. There is no impairment loss. There is no excess depreciation. So the amount of the profit will be 5,40,000, out of which NCI will get the profit of 20%, which is 108,000. What if it was from the parent to the subsidiary? So if the parent company sold goods to the subsidiary, there will be no adjustment in NCI. We are taking the percentage on the gross amount. It's up to you. You can take the percentage on individual items, or you can take the percentage on the final answer. Your answer will be same. No, 5,40,000 is the adjusted profit of the subsidiary company, out of which 108,000 is related specifically to NCI. The remaining amount will be related to the profit of the subsidiary attributable to the parent. Any question? So now here is a format for you guys. So there are a lot of students who might ask about the format. So this is the standard format for the consolidated income statement. You need to prepare at least 2 to 3. How do we apportion to the parent and NCI? Okay, I have guided you the format for the calculation of NCI actually. This was the format. Sorry, this was the format through which you can calculate the NCI figure. So if the profit after tax of the group is assuming 5 lakh, and from this format you have calculated the NCI figure as 50,000. So the remaining profit will be distributed to the owners of the parent. That will be 4,50,000. So this portion will be always be the residual figure. So what is important is that you should know that how to calculate the NCI figure. Changes in CC means contingent consideration. So this is the overall format. If you can learn this format, it will be very beneficial for you guys. And examiner, believe me, examiner is more interested in asking the question related to the consolidated income statement than the balance sheet. So for this attempt, I think income statement is more examinable or important rather than the balance sheet. So this is the format, and this is how we can attribute the profit between the group and NCI. So I have again shown the format for the working of NCI. So if you will be able to calculate the NCI, then the owner share of the owner's parent will always be the balancing figure. So here are few questions for you guys. Because of the shortage of the time, I want you guys to attempt it at home. That's your home assignment. That's your home assignment. So tomorrow we will start with this topic, gain or loss and disposal. So tomorrow we'll be discussing on the disposal along with the interpretation of consolidation. And if time permits, we will start the final account by tomorrow. Okay, I will share the answers on the group. Please do join the group. If you have not yet joined the group, you can send me the message on the WhatsApp. I will share the answers with you guys by tonight. So what is the dividend received from this associated district? Yes, as we have discussed that the dividend, because we are taking a share of the profit, whole profit. So if we have received some dividend, it should be deducted. So please give your valuable feedback about this session, that are you guys are getting benefit, and do these sessions are important for improving your concepts. And if these sessions are useful and helpful and improving your concepts, please give your feedback to the ACCA, because ACCA works on the feedback of the students, and ACCA conducts these types of sessions on quarterly basis, free of cost for the students. So I think it's very good for the students. And I want you guys, all of you, to do participate in the question and answer sessions and try to attempt my assignments. And a special message for the repeater is to attempt uh, is to follow my special plan for you guys. And if you have any issue, you can contact me on the WhatsApp. I will not be able to answer your queries in the group, because there will be a lot of discussions. So if you have any question, you can contact me in person. Thank you so much. To take care of yourself. We will be having our next session by tomorrow at the same time. Allah Hafiz. Okay, there is a student who wanted to tell me that these teachers wanted to study 8 hours. How do we, if we work? I think if you are at work, you need to take some leaves for the examination, because you need to sacrifice your work for the examination, because these are very tough examination. You cannot pass these papers if you are working continuously till the examination date. So it's my humble request to you to make a request to your employer to give you some room, and to give you some off of at least 8 to 10 days. Thank you so much. Take care. Bye bye.